we call capital assets what here? Pricing model, isn't it? Capital assets pricing model, what we call CAPM. And if you remember very, very well, this CAPM, basically, we use what we call, we use the beta factor, which basically is used to measure what we call the systematic risk. And we went ahead and wrote something down, friends. We say that CAPM returns will be equal to what? CAPM returns will be equal to, rich people must always start with risk-free investment, isn't it? So risk-free plus what here, somebody? The other market investments now. Remember the other market investments, we generate what we call expected returns of the market. Yeah. Minus what here? Minus risk-free to get, in this case here, what we call risk premium. Risk premium. And then outside here, we shall multiply with what we call what here? Beta S, like that. Outside here, we shall multiply with what we call beta S. So then today, under portfolio management, we're going to look at what we call the security market line. The security market line. The security market line, SML. The security market line, SML. The security market line, SML. The security market line, what we are calling the SML. So tell us there very fast that this is also known as the capital market line. Also known as the capital market line. The capital market what here? Line. CML, not CAPM, but CML. Now SML, ladies and gentlemen, it uses the total risk. It uses the total risk in evaluations of returns of securities. Returns of what here? Securities. So it uses total risk. It uses total risk in evaluations of returns of who? Securities. It will be very important for us to mention there that total risk is calculated as the standard deviation of returns of securities. Total risk is calculated as the standard deviation of returns of what here, somebody? Of securities, like that. So whenever we talk about CAPM, we use beta. Whenever we talk of SML, we shall be using what we call standard what here? Deviation. Now, ladies and gentlemen, please remember there is something very, very important. I've written up to here. We are okay up to here. So then when they want us to give them the SML returns, or what we shall be calling CML returns, we shall use the same approach like the one we have for CAPM. So shall come and take here risk-free plus ERM minus risk-free. All right, everything the same. And then outside here, what shall we do? Instead of talking of risk as beta, we shall talk of risk as what here, somebody standard deviation. So you take standard deviation of the security, all over standard deviation of the market. So then are you able, guys, to highlight this either using like a line using a red pen? Because this CML or SML returns is very, very popular in your exams. Very, very popular in your exams. Now then somebody may ask here, I mean, how comes when you are telling us that this formula is pretty similar to this other one, and yet we don't have BM here? How comes? You know, you should have had the BM for us to know what is similar. This BM is always there, although silently. Why? Because BM, beta of the market is always equal to what? Beta of the market is always equal to 1, yes. Beta of the market is always equal to 1, and that is why normally BM disappears. So you will forget about everything But you will never forget something to do with these CML returns. And for us to be able to appreciate what we're talking about tonight, or rather this evening, I would want us to look at August 2023 morning paper. It was a morning paper, question number 1C. So August 2023, question number 1 cow. August 2023, question number 1 cow. Question number 1 cow. August 2023, question number 1 cow. There is a girl here who does not want me to use her past paper here. Her name is Millicent, a great friend of mine. Yeah. Although with technology nowadays, and there is something I've folded inside there, so don't touch it. All right. So in this case here, we are looking at August 2023, question number 1C. Once you guys get it, like the physical students have been able to get it, the online students, once you get it, there is an emoji there, which you can use to dance a little bit. Yeah, dance. Unfortunately, I've never met any accountant who knows how to dance. Hata wanaume wale wako hapa, ukiwaambia wacheze bolingo hii hawawezi. Lakini ya Mungu mnajua kucheza, si ni kweli? Ya Mungu tunajua kucheza. Washapata already. Thank you so much. Thank you so much. All right. So then we are reading here. We are told Simon Kobia, an investor in evaluating. An investor is evaluating 6 portfolios with the following characteristics. So they've given us the expected return of the portfolio. They have given us standard deviation. Then they have given us the expected return of the market portfolio is 12%, with an accompanying standard deviation. An accompanying standard deviation of what here, somebody? Are you able to see the risk-free rate of return? Wanasema ni ngapi, somebody? 5%. So using CML, advise the investor on which portfolio is inefficient, super efficient, or what here efficient. You know, I taught you how to do that, but using CAPM. But now this time around, they want us to use CML, which is also known as SML. So then my good students, the very first thing that I will do there is to write the formula. We shall write the formula. So remember, we are doing August 2023, question number 1C. And we are looking at the CML returns of a security, which will be the risk-free plus ERM minus risk-free into standard deviation of S over standard deviation of what here? M. When I was online, I'm so sure this could be like a little bit of a problem because you guys haven't reached here. You guys haven't even started the portfolio management, but we shall overcome. The good thing is that you're very bright. You'll be able to do what a buffalo soldier does, isn't it? You are fighting upon arrival. You fight on arrival. So, of course, this is what we call standard deviation. Standard deviation of a security. Standard deviation of a security. And then we have standard deviation of what here? Standard deviation of market security, the benchmark security. For the sake of the online students, the physical guys, you don't have to write this. Now you're experts, now you write. And like, you know, you don't have to write like ERM stands for what? You guys already know this, isn't it? Expected returns of what here? Of market. Expected returns of market security. And then we have our F, which is what here? Risk-free rate of return. Risk-free rate of return. So then let's get these CML returns for each security. Let's get the CML returns for each security. Abracadabra. We start with security portfolio 1, isn't it? So now we are getting CML returns for portfolio number 1. For portfolio number 1. So naandika to CML R1. CML R1. CML R1. Can I rub this today? The person who has set the camera for me. Ameniwekea board kidogo. Yani ndio board yangu. So mara mingi nitakuwa nafuta sana. Nasema mkuu wanafunzi wa kuandika haraka. So yeah, abracadabra CML returns 1. So are you able to see the risk-free rate of return here? Ngapi somebody? Ubasa wanafunzi online wamekasirika, sio wanakasirika kwa nini? Hata waongei. Wanafunzi online hata wachangi. Kawaida wanachangianga. Yeah, Sylvia ameona already. So risk-free, wamesema ni 5, isn't it? Then you can either put the or you leave the percentage, isn't it? Plus, are you able to see the expected return of the market portfolio? For portfolio 1, what is its expected return of the market portfolio? Huh? 19, right? Wongo. Okay, expected return of the market is always known in advance and remain constant for all of them, isn't it? Manager wengi wa AFM wanachukuanga kila moja kwa hiyo wanga ifluctuate. ERM inakuwa the same for all the security. Nilikuwa nataka kwa confuse kidogo lakini naona mko macho kabisa. Nimeweka mitego pande yote. So tuko na ERM is 12, isn't it? Yeah. The online ninjas, are they able to see that 12 really? The online ninjas, are they able to see that 12? These online ninjas, we will not be inviting them to our class because kama wataki kuongea sasa na wako 26. Are they able to see that market portfolio return is 12? Uko chini kabisa, yes, at least one student ameona 12. Minus risk-free which is 5. Then for this portfolio 1, are you able to see its standard deviation given there by the side? Yes. Wanasema ni ngapi somebody? 8. How about standard deviation of the market? Iko chini tena, isn't it? Iko chini 4. Percentage tuachana nazo zitagongana zitatoka nje. Percentage zitatoka nje. Asante sana Mwambulo. Asante Maureen. Now ameanza kuongelesha now. I'm a very happy man. So kutoka hapo leo sina calculator yangu. Nilisema ndio shapata kule moja pata answer. 19 hebu kidogo zaidi kwa calculator yako jamani. So angalieni wanafunzi wangu hapa tuna calculate hiki kitu. Tunasema 5 plus you open brackets, isn't it? Unasema 12 minus 5 you close, isn't it? Alafu unasema usikaseme equals anywhere in between mpaka umalize mwisho. So unasema times 8 alafu unasema divide by 4. So then this will give me how much here somebody? 18 like. And then I will be able to go and do exactly the same for every other security. You go to CML return security 2. So CML return security 2 itakuwa namna gani somebody? You see risk-free will not fluctuate. Market return will also not fluctuate. That will remain as 12 minus 5. What I know that always changes is the risk profile here. It is the risk profile here, Bwana James. Risk profile, the standard deviations will change. Is there somebody who is able to see the standard deviation of portfolio 2 or security 2? 12. So we have here 12 divided by the standard deviation of the market, which is what here? Which is 4. That also never changes, isn't it? Yeah. So Nancy, do you have an answer here? All right. Nakuja ngapi somebody? 36. 26. Kwanza hata mimi nilikuwa confused too. Sababu ni biashara gani utafanya upate return ya 36%? Sio ni itakuwa maybe unauza bangi. Yeah, haiwezekani. Ndio kuna return unapata kwa exam unakuja dapo. So inakuja 5 plus 12 minus 5 times standard deviation of S for 3. Asante sana wanafunzi online wameamuka. 4.3. Standard deviation of 3. How much are we getting there? Maureen anaambia standard deviation hapo ni 6 eh? Hii ni ya 4 najua inabaki hivyo tu. Ya 4 haichange Naomi. Sylvia ameshanipatia correct answer at 15.5. Ni kweli? Exactly. Thank you so much. 15.5. 15.5. From there we have CML. For security, what here somebody 4. So hiyo itabaki 5 plus into brackets here 12 minus 5 multiplied by standard deviation of 4 ni ngapi mtaniambia jameni? 16 eh? 16. So 16 divided by 4, which will end up giving us what figure? 33 eh? Quite high, very high. Hiyo mimi sio libangi. Siwezi ingia kwa biashara kama hiyo. Kama juzi kwa TV alikwambia kuna mama alikuwa anapatia watu pesa mingi. Karibu 20% per month return. Mpaka mapasta wakaingia wakampatia milioni 10. Mpaka kula mwezi wa kwanza, mwezi wa pili, kabla milioni 10 zirudi. Mama akaingia miti. When the return is too high, when any deal is too sweet, always think twice. Think twice. Think twice. So then we go to CML R5. CML R5. So we have here the 5 will remain. Expected returns of the market up itakuwa ngapi somebody? 12 minus 5. Multiplied by 10, over 4, which will end up giving us what figure? Somebody here? 22.5. Is that okay? And I'm so happy because this is the last one, right? Ama kuna ingine moja? Kuna ingine ya 6? Mingi sana. Mingi sana. Mingi sana. CML returns 6. So this will be 5 into 12 minus 5 times standard division. And that is somebody has 6. A 2, divided by 4. Which will end up giving us what figure, ladies and gentlemen? Wanafunzi wa online wanaona kweli Silver is too active, which is very, very good. How about the other online ninjas? Now I can see we are almost 30 students, which is really, really good. Really, really good. 8.5 Mambulo. 8.5. But you see, this is not what these guys wanted you to do. They want us to evaluate efficiencies. So to get efficiency, we shall have to look for something called Jensen's alpha value. Yeah, Jensen's alpha value, of which you can bet with everybody here. Nobody will be able to remember the formula. Nobody. The Jensen's alpha value. Alpha value. Nobody. So alpha value, alpha is the profit, isn't it?
Yes.
So they are very right. They are telling me when we take expected returns of S minus what here?
Yes.
Very good. You guys are very, I expect you guys to say CAPM and yeah, we are not using CAPM here. Minus CML returns. Upon Melishika. So expected returns of each security minus now the CML returns. And as the CML returns. All right. So we start with the first one. Are you able to see the expected return of the first one?
19.
Umepatia kwa question, isn't it? So 19 minus CML return ambao ni ngapi? 19 as well. Are you seeing 0? So then give me a classification: super efficient, efficient, or inefficient. Efficient because it's able to break even. It's able to break even. So you simply write there in brackets efficient. Yes. You simply write there in brackets efficient. When it is 0, it is efficient. If it's loss making, it becomes what here? Inefficient. If it's profitable, it becomes super. So this is exactly 0, break even, efficient. So go to number 2. Are you able to see the expected return of number 2? Inasema ngapi somebody? 25. So 25 minus CML for 2. CML for 2 is 26.
Yes.
The one we got here, CML for 2 is 26. Which gives me negative what here? So have you written there in bracket that this is super efficient? It is inefficient. It is inefficient because it's loss making. It is inefficient because it is loss making. It is inefficient because it is loss making. So wanafunzi wangu wa online wanafuata kweli ama international disaster? Wanafunzi wangu wa online wanafuata kweli? Tuko great. Thank you so much. Tuko macho. Thank you so much. 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 And then, ladies and gentlemen, we go to number 3. So number 3, is there anybody who is able to see the ones of just doing as we're doing now as 2023 question 1C? So is there anybody who is able to see for number 3 expected returns? Ngapi somebody? Oh yeah, expected return here 316.
Yes.
Minus 15.5. And I see a profit. So long as it's profitable, it is what is super efficient. So long as it's profitable, it is super efficient. It is super efficient. All right. So go to number 4. Number 4, what do we have there? 32 minus 33, negative. Inefficient, isn't it? Inefficient. Number 5. 22.5 minus 22.5, which is meaning what here, somebody? Efficient, yes, meaning efficient. Lastly, 6. 8, 8 minus 8.5, giving us meaning what here, somebody? Inefficient, yes, meaning that this is inefficient. 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 So I'm happy to hear that wanafunzi online wako macho. Nasema mwalimu atakuwa hujafika hapo kwa syllabus, sisi tuko ngangari. tumefight on arrival. Buffalo soldier hakuna kuuawa. Ifika unapata wako vita, unarudi kwa malori, unaanza kupiga risasi. Hiyo ni Buffalo soldier. Look at Roman 2 of this question. What are they asking us there? So Roman 2 of this question, Ruth, what they're doing here, wanasema in case of inefficient and compute, which are now needed to make the portfolios what here efficient. So what do we do to be able to get a 0 Jensen's alpha value? So let's start with portfolios which are either super efficient or in ni gani ya kwanza hapa ambayo haiko efficient? Number 1 of course ni efficient. Number 2 je? Inefficient. Yeah. Tuende na hii sasa hapa. Abracadabra. Tunasema portfolio 2. Tunafanya analysis ya portfolio 2. The question is, what is the standard deviation that will make it what is the standard deviation that will make the portfolio efficient? That will make the portfolio efficient. That will make the portfolio efficient. What is the standard deviation of portfolio 2 that will make the portfolio efficient here? All right. We know the Jensen's alpha value formula. Tunajua the expected what here? Minus who?
CML.
Minus the CML returns, isn't it? Yeah. I start doing the kazi. So for portfolio 2, what is the expected return of S? S of 2 I mean. 25. Yeah. Unasema minus big brackets. Do we remember the CML returns of this portfolio 2? 26, right? But you see tukichukua 26 kitakuwa inefficient. Nataki hivyo. So we need something that will be able to make this entire CML to be exactly 25. Fortunately, we know the formula of CML. Tunajua kwamba it is 3 plus what here minus RF, isn't it? Into standard deviation of S, standard deviation of what here? Hebu tuchape hizo vitu hapa ndani. Kumbusheni mwalimu hapa. This 3 ilikuwa ngapi? Ilikuwa ni 5. ERM ni constant for all the portfolios. Na mlembe ilikuwa inakuja ngapi somebody? 12. So 12 minus 5. Into standard deviation ambayo Gotire hatujui. Gotire ni a German word. You always want to know standard deviation of S. Hii haijulikani because that is what we are looking for, isn't it?
Yes.
Yeah. Divided by the standard deviation of the market, that one we know. It is what here somebody? And we expect that when I take now this, subtract this, I should end up getting efficiency, which is what here? 0. I should end up getting efficiency, which is 0. Akani kazuri. Because the picture can send 25, my brackets bado zitabaki tu. Send 5 plus body mass. 12 minus 40, 12 minus 5. The 6 umetumia calculator. Well, umetumia calculator. So ni 7, isn't it? So 7 standard deviation of S over what here somebody? 4. Is that okay? Equals what here somebody? 0 equals 0. So can we open the brackets here? So when I open the brackets, what will I get? It will be 25 minus 5 minus. You know, this minus is very, very powerful. So hapo kwa bracket tafanya maneno. Hii itachange kuwe negative. Hii itakuwa negative pia. 7 standard deviation of S over what here? 4. Equals what here somebody? 0. Sasa niulizeni swali, si 25 minus 5 ni 20. Na kataruka pande ile nyingine. 20 hapa ni positive. Kakiruka pande ile nyingine, si lazima iwe negative. Because you can never cross over the Jordan and life remains the same. Ask Raila Odinga. 25 minus 5 is 20. Crossing over, it becomes negative 20, isn't it? So negative and negative will cancel out. Therefore, the standard deviation of an S will be 20. So then this and this will go times 4 over 7 times 4 over 7. ambayo itaenda kuwa ngapi akiwa wanafunzi wa online wameona giza hii. In I can tell always because I know these students for long. This I can tell wameona giza kidogo. Alafu already wako na answer, imagine. 11.43. 11.43. Inakuja 11.43 11.43 like that. Aya, hiyo ni nimefanya the first one, which is what here in a field. So can you tell me the next one that we should be able to evaluate? There are many. There are many. Remember, we are evaluating the ones that are super efficient, or in a, we bring them to what we call equilibrium. Efficiency, we bring them to equilibrium. Portfolio. Or 3 iko sawa, 3 ni efficient. Yule amesema mwalimu portfolio 3 iko na shida. Ni efficient. Kwa hivyo ni efficient 3. Kama ni super efficient, tuna evaluate. So should we evaluate 3 or is okay? Hebu tuangalie kwa nimeandika na magari 3 nasema. Yeah, we should evaluate because the aim is to bring every portfolio there to Z. So go to portfolio number 3. Super efficient. We should evaluate it. We should evaluate it. We should evaluate it. We should evaluate it. We have to evaluate it. Sasa utapata kuna ninja mahali na kuona hapo virtually, ninja mahali amekaa tu anangoja nimfanyie. Utangoja. Mimi nimeshafanya my bare minimum. Nimeshafanya my bare minimum. My friend told man, your name ni gani? Your name? Victor. Sasa Victor. Victorine. Bwana samanga bora na nasahau tena. Mimi kaliana wapi? Anybody who knows the whereabouts of Madam Milka? Your class colleague, I mean. Wafanyi AFM. Oh, ala. Alikuwa exempted. Ameli mshtua. This is the best paper in CPA. The best paper in CIFA. We'll never go wrong. So now students are evaluating portfolio number 3. Students are evaluating portfolio. So according to Sylvia, it should be 6.26. Mamgulo is saying that this should be 9.43. So now I'm waiting for my online, or other physical students here to also shout their numbers. I like the democracy I'm seeing online. Like now, Morena has come and told me, Mwalimu, no, the first 2 students are wrong. The correct answer is 7. I like that kind of democracy. That is the democracy we need. That is the democracy we need. Ule mwenye hana calculator, you are also very, very good to us. You can become even better to us by completing the equation. Kama una calculator unasema tu answer every time unasema answer ni 0. Yeah, 0. Ndio uanze mjadala. Watu waseme no. In the process, we are lost. You're lost. Let me do it, okay? We shall overcome, right? You see, what we want is to get 0 alpha. It's an equation. So now we are looking at portfolio 3. Portfolio 3. So remember the formula stands, this is the formula. Expected return of the security minus CML. So then go ahead and give me this alpha. So for portfolio 3, are you able to see the expected return of S? What is the 16. How about the CML hatujui? So CML lazima kile bracket kubwa hivi. Na formula CML ndio hii hapa. Unaanza na risk free which is 5. ERM ambao ni ngapi? 12 minus 5, isn't it? Standard deviation is what the examiner has asked you to provide. So you divide this by what here, somebody is the standard deviation of the mark, which is 4. And then we expect the whole thing to be equal to what here? 0. So hapo naenda pole pole nasema 16 minus into 5 plus this minus this gives me 7. Standard deviation of S all over 4 equals what here? 0. So you open brackets. When you open brackets, what are we getting? 16 minus 5. This becomes minus 7.
Yes.
So 7 standard deviation of S over 4 equals to 0. So then let we hivyo kuja hapa. Nasema 16 minus 5 is 11.
Yes.
So 11 minus this equals 0. Therefore, minus 11, which will cancel with this other minus. So standard deviation of X will be 11 times 4 over 7, which will end up giving us what figure? 6.29. Iko mwanafunzi alipata correct kweli? Aha. So Ruth anasema 0.5 or 0. Now remember Ruth, what this examiner has asked us is to ensure that the alpha of the security is 0. Because the examiner has told us that for super efficient and inefficient securities, what would the standard deviation be for those securities here to be what? To be efficient here. So for them to be efficient, then their alpha value, Ruth, should be 0. Not 0.5, should be 0. Are we together there? Are we together there? Sasa imeingia vizuri. Na mimi naomba jambo moja because of syllabus coverage. Now the other portfolios mtafanya peke yenu. The very best thing you should do, just leave some 5, like 5 or whatever number of lines, which I'm 100% sure that you will never ever fill. You will never write. That one you can bet, right? I'm 100%, most of us will never fill that space. Yeah. Do you want us to check on Friday?
Yes.
Okay, great, great, great. Arbitrage pricing model. Arbitrage pricing model. Arbitrage pricing model. APM. Arbitrage pricing model. Andika chini sana arbitrage pricing model. APM, at times in this case they call it arbitrary pricing theory, yeah? So it's APM or what here? APT or APT. Thank you so much, Sylvia, to confirm what I'm saying. Now tell us that unlike CAPM, APM is a multi-factor model. It is a multi-factor model. Remember, basically, for your own revision, you can just mention there in bracket somewhere that CAPM is always single factor. It only depends on one factor, which is beta equity or beta whatever, beta. Now, anytime you want to get APM returns, so APM returns, ladies and gentlemen, we must always start with what we call risk. What here? Risk-free, always. Plus expected returns of the security given factor 1 minus risk-free multiplied by beta 1 plus expected returns of the security given factor 2 minus risk-free multiplied by beta 2 plus blah 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 end of thinking capacity, etc. Those factors here could be very many. These factors in this case here could be very many. So APM is multi-what here? Is multi-factor model. Is a multi-factor model. So can I rub this thing? Wanafunzi wana IBM na confirm I can rub it? Rub it. Yes. Yes, we shall be lessing the, Sylvia says no, we shall be lessing the risk-free because, you know, this one is what here is a risk factor, right? So you can only work with what we call risk premium. lazima always uende risk premium. So you always work with risk premium times beta. Every factor. Subtract, you get risk premium, you multiply with beta factor like that. So Sylvia, I'm waiting upon you once you finish. Done. Thank you so much. Yeah. Sasa this semester they bring a question like this. Just to scare you guys. Remember, CASNEP is the only body I know which fights with there. There are students who gives them what here? Examination fees, right? But again, they fight you. So does it mean that once you guys qualify and then you become examiners at CASNEP, should be giving out very simple exams?
Yes.
Sure. And then everybody will pass.
Yes.
All right. So then we have here exercise. We have 3 factors. We have factor 1, factor 2, factor 3. Then they have given us risk premiums in the form of percentages. They've given us here 8. Here we have 6. Here we have 4, like that. And then they've given us beta factors. So we have here 0.3, 0.2, then we have here 0.9 like that. Risk-free rate of return is 2%. Is 2%. Factor 1, this one here, represents a foreign exchange index. Foreign exchange index. Foreign exchange index. F2 stands for an exportation index. And then F3 is a market factor. And then we are required, ladies and gentlemen, we are required to determine number 1, APM returns. Number 2, CAPM returns. So APM returns, and then number 2, CAPM returns. So I'm giving you exactly 5 minutes. And then we get to see, we'll be able to bell the cat. Belling a cat is never a simple thing, Abigail. But your belly, when shingo ya cat, itakuuma. Sio watu wengi wanaweza tambua kubell the cat. Sio kitu rahisi. Kuna kitu hujaona vizuri, Is it Margaret? Yeah. I was trying hard to remember the name. APM returns. CAPM returns. So once you guys finish writing the question, you put your thumbs up like this. But the most interesting part is when you finish doing the question. You tell me, Mwalimu, we have gotten an answer, give us a present. I always give very, very presents. Kama leo kuna mahali nimeona nikaangukia kitu. I'm feeling like I should share. All right, ladies and gentlemen, life is good. So you're waiting for students to be able to give the answer. APM returns. And then, of course, if there are students who are online attending our classes, we welcome all of you to become our students at RCM. Yeah, especially if you can come physically here at Stanbank House. Yeah, we want physical students to online tumejaza sana. Online kama evening class niko na 300. Hiyo kwa wengi sana. Tunataka physical tuweze kuchukua even a bigger space in town. Kwa sababu wanafunzi wengi wa serikali mkitoka job jioni badala ya kwenda home na jam mingi. Uende ukisoma saa 2 na sisi usiku. Unakuja physical class. Finished? physical class, kuna so many advantages. For example, when I call them over here over the weekend, I buy them lunch at Sarova's family. And I'm very serious. Yeah, I'm very serious. Yeah. Do you want us to meet this Saturday?
Yes.
Yeah, great. So then please come ready. Going to eat good food with cutlery. I'm going to wash them all, right? Yeah, cutlery. Cutlery. 8 p.m. is 9.2. Umetoa wapi returns of the market? Ama you don't need? Very good. Very good. Ulikuwa umeona kwa yale mimi sama nini? Umefikiria tu. Yes. It is premium. Great. Mwanaume pia umefikiria na bwana Victor? Okay. Because whenever they tell you that this is a risk premium, already they have subtracted for you. Already they have done the subtraction for you, isn't it? Ukienda kusubtract inakuwa international disaster. So tuanze straight away na APM returns. So tuanze straight away na APM returns. So APM returns, I know this is the one of multi-factor, which is risk-free, plus expected return of the security given factor 1 minus risk-free, multiplied by beta 1, isn't it? Yes. Plus expected returns of security given factor 2 minus risk-free, multiplied by beta 2. Mwandikia plus ETC, isn't it? Yes, that when the kazi. So APM returns will be equal to, what is the risk-free rate of return? 2. And my students, I'm really surprised that they've been able to know that this is premium. Already they have subtracted for us. So we should only pick this, which is what here, times beta 1, which is 0.3. Plus the second premium, which is what here, times beta 2, which is 0.2. Plus what here, somebody, 4 times. Will we be able to get what Nancy got? So Nancy got to what return? 9.2. 9.2. Thank you so much. 9.2. Thank you so much. Now from there we go to CAPM, isn't it? So CAPM, this one I expect you now to do it. And if possible, you can even come and grab Margaret, this pen for me. And then you tell me, Mwalimu, I'm doing this on the board. Let these online students, in this case, they get to know me. Is there a problem with that, Margaret? Why? You're accepting too fast. You don't like public speaking, right? Lakini wanafunzi wa online wameelewa kweli vile nimefanya. Wanafunzi wa online wameelewa kweli what I've done here to get APM returns. No, wamesema no. Maureen wamesema no. Gloria wamesema kabisa. So Maureen, you see, we normally start with risk-free. Risk-free is 2%, but I'm omitting the percentage because you can see they were capturing everything in form of percentage. Plus, you should not take this ERS1 and then you say you're subtracting 2. Because premium means what here? Over and above? Over and above. Premium means over and above. Already they have subtracted for you. Yours is to pick the premium the way it is given. Now you subject it to the beta factor. So don't subtract again. There's nothing to subtract. So you take in this case here 8 times 0.3 plus the second risk premium, which already have subtracted for me. Right? Whenever they give me premium, there's nothing to subtract again. So you come and take 6 times 0.2 plus, we have here 4 times point what here 0.9. So I believe in this case, somebody has been able to pick this up. I believe Kelvin, thank you very much for saying no. That's very good. That's very good. That's very good. But I hope now with that little explanation, you've been able to now get this thing live. Is that the case, Kelvin and Maureen? I'm about an international disaster. You're okay now. Thank you very much, Kelvin. Now I'm waiting to hear from this great lady called Maureen. Now, CAPM, unlike APM, APM ni polygamy. Na CAPM ni nini? Monogamy. You know the proper term. Monogamy. 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 Na bibi yake namna gani huyo monogamy? Bibi yake namna gani huyo monogamy? Sasa, sikize vizuri. Tunasema CAPM returns will be equal to risk-free into, it always makes use of a market indices, market factor. So ERM minus risk-free multiplied by what you be? Beta. So among these factors, is there any factor which is market-based? Is there any factor which is market-based? Factor what here? Factor 3. Factor 3. Therefore, my CAPM returns will be equal to this, which is 2, plus now the third premium, isn't it? Because you see, first premium is something to do with the foreign exchange index. That's not a market thing. Second one is about exportation index. You don't even understand what it is. But F3, they explained and told us that F3 is about what your market. Yes, factor 3 is about market. Now, BB CAPM the market, isn't it? So in this case, hapa, hii inakuwa risk premium ya 4 multiplied by beta yake ya S, which is 0. What here, somebody? 0.9. 0.9. So that are you able to give me this answer, my friends? Ruth anasema ni 5 point what here? Ruth anasema hii mwalimu ni 5.6. Mwalimu ni 5.6. Thank you very much. 5.6. Thank you very much. Thank you very much. Thank you very much. Thank you very much. So next time, if you help me with that past paper of yours, there is something more that I want to demonstrate. You send. Great. So then I would want us to look at our past paper. So this past paper of ours, I would want us to straight away go to quite a simple one. Simple questions. The next topic that I'm going to do here, which topic should I do next? So the one that I would want us to do here is November 2019. November 2019. Question number 3, Carl. November 2019. Question number 3, Carl. November 2019. Question number 3B is your homework because I've done exactly that same question in class. Question number B, now that you guys have told me that you love homeworks. Now that you've told me that you love homeworks. Now that you've told me that you love homeworks. Thank you very much. Now that you've told me that you love homeworks. Question number 3, boy, you shall do it as your homework. Ah. So can we read it? 𝐬𝐥𝐢𝐧? Yeah. Online guys, have you been able to get this question? And it's November 2019, question number 3C. Question number 3C. The online gurus, online ninjas, once you get this question, can you kindly put your thumbs up like this? Live, like this, live, like this. So then, having gotten access to the LMS, have you known how to use it? Because how you use it, you simply go to where they have written like whole syllabus. There's a place there that has got whole syllabus videos. So your whole syllabus, unaanza kuzwatch your pole. Yeah, unaanza kuzwatch pole, whole syllabus. Thank you so much. So nasema 𝐬𝐥𝐢𝐧, a serious investor, this guy is a serious investor. 𝐬𝐥𝐢𝐧, an investor, believes that there are 3 important factors that determine the expected return for a particular common stock. Job uses the following factor betas and the factor risk premiums here. So you can see factor betas and the factor risk premium. The risk-free rate is what here? 5%. So they want us to give them for 2 marks. Expected return for the stock using arbitrage pricing theory. So can I sit down a little bit to do that question? Yeah, great, beautiful. But in case there is an online ninja who will not be writing anything, please tell me so that we can do some little of stories. This mwalimu loves stories. All right. All right. Yeah. Okay. Finished? Are you sure? kuchanganya. So I can see the online guys like Ruth N. She's already getting 12 points. We have about 12.15. You remember ngapi kwani? 7 points. 6.75. How comes online ninjas are getting 12.15? How many may subtract your risk premium? You know already wametupatia premium. When it's premium to us, we shall always not subtract. How about this online ninjas are doing a different question? Wamesahau na negative, eh? Yes. Kuna ka negative kadogo hapo. Yes. Thank you so much. Now you see, now these guys are correcting us. So the after Korea para 12.15. 3 of them imagine online. There must be a problem, isn't it? Yes. They are not keen, eh? You must come and physical. You guys need to be more serious now. Oh, we have factored the negative, eh? We have factored the negative. Unasema wamefactor pia the negative. Wacha tuone abracadabra. Sasa hapa ni hapo. The only person who will be able to decide the winner ni mwalimu sasa. Okay. So then, this is what we have here. So, sasa kuna shida moja. Shida moja ni gani? Nitafuta kwa nyuma kabisa. Tabia kweli kweli. Tulikuwa baya sasa. Let's pray itafika. Upitisha hivi. Bora kama itafika. Itafika ni ndefu. Charges. Good, imefika hiyo. Nikaribia. Imefika hiyo. Wanasema mwalimu online, we cannot be wrong. We cannot be wrong. Hata nyinyi si wachache. Sasa tuende kazi. All right, are you guys able to hear? I can see they can hear mwalimu. So APM returns, right? So see risk-free plus we have the expected return of security 1 minus risk-free multiplied by beta plus expected returns of 2 minus risk-free multiplied by beta what here? Plus it is, isn't it? So let's look for these numbers. So then APM returns will be equal to risk-free ngapi? 5. Unata percentage? Yes. Plus, are you able to see the first premium? Yes. Ngapi? 2.5. 2.5. Yes. Times the first beta? 0.7. 0.7. Yes. Plus the second premium? 5 times the second beta? 1.2. 1.2. Plus the third premium? 6 times 0.1. 0.1. Hebu weka kwa kalkuleta hiyo figure yote. 12.15. Hiyo mlikuwa na ngapi? Por mlikuwa mfanya nini? Wewe mlikuwa na confidence. Hebu nipatie. Nipatie. So, tuseme 5, isn't it? Hakuna bracket mark, hakuna bracket mark popote. Nimejua kwa nini unapata. Unaona madam amefanya. Ukiona hapa amesema -6. Yaani ameassume kwa akili kwamba ni 6. Akimultiply. That is why no accountant in this case should use their heads to compute. We should always use our calculator. Even if you see 1 plus 1 as an accountant, you should always use your calculator. Always. So 5, and you can now see it from different corners. Mlichukua nyote ni C. Makosa si huyu peke yake ni nyote. So plus 2.5 times 0.7 plus 5 times 1.2 plus 6 times minus 0.1. Hebu rudia tena uniambie. Rudia tena uniambie. Tuko ngangari, yes. Tuko ngangari, yes. It is 12 point what here? 12.15 is correct. Is correct. Now then, with your permission, I will be able to straight away go to the next concept here in Roman 2. They want us to give them the differences between CAPM and what here? APM, isn't it? I'll do a table. So we have CAPM and then we have APM. So we have CAPM and then we have APM like that. So CAPM, I always remember the first one that CAPM is what here? Single factor, isn't it? Yeah. So CAPM is a single factor model. It's a single factor model. That's number one, isn't it? And then number two, what do we have here as an APM? Yeah, multi-factor. Thank you so much. Multi-factor model. Multi-factor model. That's the first difference. Number one. Number two, CAPM is single period. Single period. Single period. All the returns under CAPM must be on a per annum basis. Like for example, 7% per annum. But here, APM is multi-what here? Multi-period. It's a multi-period model. Multi-period model like that. And if you return your 5 years, itachukua. So flexible. The other thing you're supposed to know, ladies and gentlemen, is that CAPM always assumes normality. Normality. It always assumes what here? Normality. APM can work with any type of distribution. APM works with all types of statistical distributions. Statistical distributions. Equally mesocratic, whatever, equally gani, APM works with all types of distributions. This one assumes normality, ile hesabu ya Mluya. Unaona kama for example hapa, ya, nitaka tukule ugali mzuri zaidi, na maziwa mala, unatafuta Mluya. Ni Mluya tunaweza kupikia ugali which is very symmetrical. Hao wengine wale wajaribu kinanasi kama atapika ndio mzuri lakini hawezi kukua, ile unaweza cut into two equal parts. Hawezi kubali, lakini hiyo ni kitu Waluya wanaje. Kila kabila iko na strengths zake, si kweli? Iko mwingine anaweza pika ugali lakini kweli kama uji, lakini ugali. Mzee kwa nyumba unakula. So this one normally assumes normality, that the returns are normally distributed. Lakini APM hata kama hiyo mlime inakaa namna gani, atakaa inakaa hivi. Atakaa inakaa hii inakubali all those distributions. That all the returns in this case must not be centered at the mean. APM in this case here, this thing does not have to be symmetrical. But for CAPM, the returns are normally what are distributed. So about those extreme factors, you're going to have very less probability extreme factors. But all the factors in this case here, the returns will always be very, very symmetrical, will be at the mean here, near the mean like that. Number 4, CAPM, in this case here, CAPM uses what here? CAPM uses beta factors. Only beta factors to measure risk. Ladies and gentlemen, APM can accommodate. It can accommodate other measures of risk. It can accommodate other measures of what here? Risk, like standard deviations. It is. So those 4 zimetosha wewe kabisa. Ni gani ile ambayo huwezi ukasahau forever? Ya ugali ya Mluya. Mimi niko kwenye ugali ya Mluya. Ya ugali ya Mluya. Ya ugali ya Mluya. So kila kabila iko na talent yake. Kama ni wamama wa Coast, watafika mchele kutoka asubuhi saa 3 ni mchele ya jioni. Ilikuwa tamu sana. So kila mtu ana talent yake. Namna hiyo. Ndio talent yake namna hiyo. So very good, very good. Now from there, we go to portfolio performance measures. Portfolio performance measures. Performance measures. Portfolio performance measures. Portfolio performance measures, of which here the first model is a Jensen's. The Jensen's alpha value. That's number one. Number two, we have in this case the Sharps. The Sharps coefficient model. And then number three, we have the trainers, yes. The trainers coefficient model. This one, I will not look at it. I would want us to start with what here? The Sharps model and this other one here. Sharps model and this other one. So naomba past paper tena. All right, we shall overcome. Pia nyinyi kwa past paper zenu, tafini kwa past paper zenu zimejaa. Mbona moja imeandikwa Sharps ama trainers. Zimejaa all over. So please remember the physical students. I would wish to meet you here on Saturday. We said we shall be coming on the weekends, once in a while, isn't it? Yeah, at exactly 6 p.m. So that what we start next, itaisha haraka. And then of course the physical or other online students, we shall also welcome you to join us. We shall be joining all our classes. We shall be joining all our classes, all our physical classes. We shall be joining all our physical classes. All right. Yeah, like somebody is saying August 2022 question 5C. Online, Maureen, to join you. Mwingine amesema hapa tuende kwa August. Hebu endeni kwa hiyo August. Muone kama anasema ukweli ama anadanganya au msichana huyo. August 2022 question number 5C. Question number 5C. August 2022. Niyo wamesema mwalimu iko hapo. Wamesema mwalimu hapo kuna maneno. August 2022 question number 5C. Question number 5C. Inauliza Sharps na trainers, and inauliza trainers together. Oh, great question. Then that is great question. Shika hiyo. All right. So, are you able to read the question for me now? We shall overcome. So, thank you so much. So, it's August 2022. So, August 2022. Question number 5C. So Sharps uses standard deviation to measure portfolio performance. Portfolio performance. And how do we get this Sharps thing? So to get Sharps coefficient, you shall take the expected returns of S minus risk-free. Shall take expected returns over the security minus risk-free. And then you divide this by the standard what here deviation. You divide this by the standard deviation. You see, Sharps and standard deviation. There is some kind of a similarity, isn't it? Any like to come with a tongue twister. If can tie, and untie, a tie. You remember those things? It will be Sharps, not standard deviation. So then how many securities do we have there? 1, 2, or 3? There are 3, yeah? Wanazita A ama 1, 2, 3. So tuanza na S ya A. So is there somebody who is able to see the expected returns of A? Expected returns of A. 17.55. 17.55, right? Yeah, expected return is the same as average return, right? Expected return is the same as average return. All right. All right. So already ushapata. Unasema hii ni 17.55. Have they given us the returns of the risk-free returns? Unasema ni ngapi? 14. Are you able to see the standard deviation? 7, eh? Risk-free is 7. What risk-free ni ngapi somebody? 7. All right. 7. How about the standard deviation of the security? Mbona unapata figures tofauti tofauti? Standard deviation, not of the market. This is security. Ile ambayo inaambatana. Ni 30, eh? Online wanafunzi wanasema kweli hivyo 30. Online wanasema kweli 30 pia. Gloria ameconfirm 30, yes. Gloria ameconfirm 30, yes. Gloria ameconfirm 30, yes. So hapo ukicheza kata kuangusha kaka kitu waka body mass. Sema 17.55 minus 7 equals 1. Whatever answer you get, you divide by 30. Whatever answer you get, you divide by 30. Zero point. Mnaogopa kuongea. 0.35. Thank you very much. That is sharps for A. How about sharps for B? So are you able to see the expected return of B? Ngapi? 13.26 minus risk-free ngapi? 7. Over what year? Over 44. 34. Thank you so much. 0.18. Yeah. Twende kwa SC. SC, are you able to see the expected returns of SC of C? 9.34 minus risk-free is over what year somebody? Over 28. So divided by 28. So this one is giving us what figure? 0.08. So remember, the higher the sharps, the better. The higher the sharps, the better. The higher the sharps, the better. So then you will be able to go there and pick the number 1 here will be A. You rank them like that. 1, 2, 3. Why 30? Remember, it is standard deviation of the security, Gloria. I mean, Ruth. Not standard deviation of the market. I'm going to show you over too. Very question. Ukiangalia to A vizuri pale. Average return is 17.55. And it has a standard deviation of what here somebody? 30. 30. All right. It has a standard deviation of 30. Now from there, we should be able to go to the trainer's model now. So trainer's model. Trainer's model. So trainer's model. So trainers. Trainer's model. So this one uses beta factor. It uses beta factor to evaluate portfolio performance. It uses beta factor to evaluate portfolio performance. Then how do we get this trainer's coefficient? It's very easy. Just the same. ERS minus risk-free over beta over security. beta over security. All right. So we start with, you see, if you look at the entire question, they have not given us betas. Yeah, they have not given us betas. So then we must calculate beta first. So you calculate beta. So then beta over security equals covariance between the security, covariance between the security and the market. Covariance between the security and the market. Divide this by the standard deviation of the market squared. Divided by the standard deviation of the market squared. It's a formula to be crammed. And many people have taught this AFM over 23 years, ladies and gentlemen, and I've always seen people passing, so they crammed and passed. You can as well do the same. So please highlight this. Beta over security equals covariance of the security and market divided by the standard deviation of the market squared. So then have they given me for A, are you able to see the covariance between A and M? What is that covariance? Kadogo sana, 0.0088 divided by, are you able to see the standard deviation of the market?
Yes.
Ngapi somebody? 10, so 0.1. 0.1 squared, isn't it? Do you know why I'm putting this as 0.1 and not 10? It's because the covariance up there has not been given in form of percentage. See, covariance in a percentage.
Yeah.
So then I also must make this to be a normal number. Yeah, because I would have only, like, ukiangalia vizuri tulifanya ingine, it's in form of percentage. But this covariance has been given as a real number. So even our standard deviation here has to be given in form of what here, a real number. So then is there somebody who is able to give us this BA? Nasema inakuwa 0.88.
Yes.
Thank you so much. 0.88. Thank you so much. Right? So go ahead and give us beta B. So beta B will be equal to who? Beta B. So beta B, I should be able to take something divided by something. Are you able to see the covariance of boy? Wanasema ni ngapi somebody? Boy niko peke yangu lakini overcome 0.75 divided by 0.1 squared, isn't it?
Yes.
Yeah, but you see, even if you have to leave it like just tens, I mean, nobody can ever penalize you for that. Yeah, although to be professional, we need to know that whenever this is a real number, this other must also be a real number. So mnapata beta B and ngapi somebody? 7.5. 7.5. How about beta C? I should take what divided by what here, somebody? 0.0021. Divided by 0.1 squared, isn't it? Which will end up giving us what figure, somebody here? 0.21. Thank you so much. 0.21. Thank you so much. So the online ninjas, are we together up to here? The online ninjas, are we really together up to here? Like this one here, we got 7.5. I can see I've cut you off. So this one here, we got 7.5. And this one here, we have gotten 0.21. Now after that, now you can easily go and give us the trainer's coefficients. The trainer's coefficients. So come here quite well, thank you very much. So come and give us the trainer's coefficients. So we know this is the expected return of S minus risk-free over beta factor, isn't it? Yeah. So then for A, are you able to see the expected return of A? That is somebody? 17.55. All right, minus risk-free amount ngapi? 7, eh? Yeah, over the beta that we have just obtained here, which is what here, 0.889. So please move slowly. Give me an answer. Move slowly. Give me an answer here. Now these guys are fearing. These guys, we have punctured their ego. 11.99. But even the online guys are not giving us answers. Is their ego as well punctured? Yeah, which is about 12, isn't it? So then go ahead and give us for B. For B, what do we have there for B? 0 point. No, another one, the answer. 13.26 minus 7, isn't it? Over 0 point. Over 7.5, isn't it? Over 7.5, which will end up giving me what figure? 0.88. Is that okay? And then we go to C. See what we have there under C. I should take something. 9.34 minus 7 over 0.21, isn't it? Which gives me what figure? 11 point. Please go ahead and rank them. So the higher the trainer, the better, right? So which one takes number 1? This takes number 1. This will take position 2. This will take position what here? Position number 3. And that now marks the end of our class, because I happen to be having another class at exactly 8 p.m. But that dose is enough. I'm back in Kiso. Mko na LMS and everything. Yes. Kuna maswali. All right. Thank you so much. So like you're going to go and choose LMS. Great online ninjas. Great. All right. So then I'll be inviting you guys. I can see you have enjoyed our today's class. I'll be inviting you for this 6 p.m. Yeah, it's always Monday, 6 p.m. Then we have Friday, 6 p.m. Then we have Saturday, 6 p.m. Thank you.